We've watched the major U.S. indices rally just the last few days. You're talking about the S&P 500, the NASDAQ, where now they're both within, a couple percent of their all-time highs. And I can't help the feeling that I should be selling, trimming down my portfolio, raising cash, just because so many different signals. You see the high inflation rate. You see a Federal Reserve, calling out, look, that they're pulling liquidity from the system. And I've done prior videos both on this, the Federal Reserve, as well as Stanley Druckenmiller, one of the greatest investors of all time, effectively saying his approach is to track liquidity, what's going to liquidity, because that will drive asset prices. And here it is, the Federal Reserve saying we are pulling liquidity from the system. We're going to be raising by potentially half percentage increments. We're going to be selling down our $9 trillion balance sheet. Both of these things could pull significant amounts of liquidity from the system, and it's hard to see how risk assets should continue to appreciate in the face of these headwinds. Now, it's going to play out over the upcoming months and quarters, but you also see interest rates moving higher, with mortgage rates moving higher significantly in just the last few months, from around 3% at the start of the year to now 4.5%. That's going to have a direct read-through to the home builders. These home builders, they have inventory that all of a sudden, is it going to be harder for them to sell because people can't afford the homes as easily because interest rates have gone up from 3% to 4.5%. That's effectively a 50% move in terms of the interest rate. And so you're looking at that, and these home builders, will they have to effectively trim down, mark down their inventory? And does this have a read through ultimately to the economy? Or let's say they say, we need to just sell down our existing inventory. Let's slow down on building new properties, which arguably could actually make pricing even worse. And so you do have these concerns. So what is working? What is actually working when you check across multiple ETFs? And once again, this is another trick habit that I've gotten from studying Stanley Druckenmiller, where he goes, you look at the market, but the reality is there's a market within the market, and seeing what's actually working within it. And the reality is, you check out different sectors. There, not a lot is working right now, folks. You see effectively oil and energy producers, and you see mining. And if you check around the world, and I was just recently checking literally dozens of country stock markets around the world. Pretty much the only ones that are trending in a favorable way right now are either oil exporters or mining exporters. And check it out yourself. I encourage you to say, Daniel, hey, I think you're full of baloney. Here's this country that's actually doing really well. But then the reality is, you start thinking, wait a second, is this a major oil exporter or a major mining exporter? And for the most part, those are the countries that are, where capital is flowing to them right now, because they're seeing the repercussions of the invasion, into Ukraine by Russia. And so looking around the world, looking at the U.S., really the main sectors, the main spaces that are working are oil and mining. And how the politicians are reacting doesn't give me any confidence. You're seeing politicians like the governor of California talking about sending stimulus checks for $400 to California vehicle owners in response to higher gas prices. And this is not a incompetence problem just to California. You see it around the world. Germany also unveiling fuel subsidies. Now, they are doing things like discounted public transportation. That makes sense. Fuel subsidies is just complete disconnect from understanding economics. That's my concern here, is if you had leadership that were thinking about these problems in a serious way, I'd say, okay, this, the world can muddle through and it'll be okay. But if you have incompetent leadership that's just looking to game the system, they can arguably make it worse. And so, for example, if you have a basic situation like a shortage of supply, the natural recourse is higher prices. Higher prices ultimately lead to demand destruction that ultimately, keep things in check. But saying, oh yeah, we're going to, we recognize there's a problem with higher prices, so we're going to borrow money or just, give stimmy checks to help you deal with those higher prices, that actually makes the situation even worse and can result in even higher prices. So this is just completely backwards policies, that I'm seeing. And it's the same leadership that, previously seen, anti-nuclear initiatives, which is just completely mind-blowing to me. So here it is, shutting down nuclear and subsidizing, gas and oil. This is supposedly out of one of the cleanest, leftist states, California. Just doesn't make any sense when you think about it from a policy perspective. And then you're looking at, valuation metrics. And you look at very basic things like price to sales ratios for the S&P 500, which historically over, long time period has actually had a pretty high correlation to multi-year, correlations, saying if you were to look at this metric, this price to sales metric, and look at how it trends over the next 10 years, how the subsequent returns look like over the next 10 years, it actually has fairly reasonable, correlation, pretty high. And this is part of the reason why if you look at like what Vanguard or how Vanguard forecasts market results, they often do something very similar, saying, hey, is the valuation high or low? And, looking at this, the S&P is near all-time high price to sales ratios. So despite all these concerns, it's not like it's being priced in at all, I'd argue. So it's not like, oh man, this is bargain basement territory. That's not at all what's being priced in looking at this. Now you might have some investors say, Daniel, don't worry, about the market. My approach is just to dollar cost average. I'm going to be fine over time. And, my concern is you're going to be about as fine as this person over here that's about to get kicked off a cliff, because the reality is a lot of investors look back at, let's say, the last 30 to 50 years, and they're looking at the data from that period and they're saying, hey, that's fine. I'm looking at the past and future is going to be great as well. And the reality is, I think we are facing a changing world order. Ray Dalio's called this out, where you're looking at events that will happen, let's say, instead of once every 30, 40 years, you're going to be looking at events that happen maybe once every 100 years, maybe once every 70 years, things that a lot of people haven't priced in. And that's the concern. You're going to be dealing with things where ultimately dollar cost averaging doesn't work. Talk to all the Russian investors, for example, that have been dollar cost averaging the last few months, and now they're looking at effectively 90% plus haircuts, that they're not going to be recovering from in all likelihood. And Ray Dalio's called this out, in his book, The Changing World Order. You can watch the video on YouTube, but, it doesn't have all this detail. He highlights literally dozens of countries where the stock markets effectively got wiped out, whether or not it's from war, from some sort of, political revolution, or from inflation, over time. So that is really worth understanding, where the real cumulative returns over periods are hugely negative, 70% plus up to 100%. So what's my take as I consider, all of this, and, how am I thinking about investing? And once again, this is not financial advice. I'm just sharing my own personal investment journey and how I'm considering all this. So first of all, I am trimming. I am looking at this and saying, even if the markets go to make all all-time highs, I'm not particularly compelled by this value proposition. I'm not saying, hey, the valuations are dirt cheap. I'm very skeptical of this rally, and I'm concerned. And also, you look at what Warren Buffett does. Warren Buffett, it's not like he's finding crazy bargains. He bought a one-off insurance company in Allegheny. He's making a bet on oil, which I already called out. That's one of the few things that is working with Occidental, putting a few $1 billion there. You look at other investors like Michael Burry. He's effectively trimmed down his holdings significantly. I did a prior video on that, how he's effectively, the amount of money that he's put in the stock market is pretty de minimis relative to his portfolio. You have famous investors like David Tepper, one of the greatest investors of all time, just a few months ago saying he's not really finding anything. And so I'm personally looking at this and saying, this rally, maybe I should be trimming more and selling more. And so that's what I've been doing. And Unrivaled Investing Journey subscribers, they see, what I'm trimming and selling. Also what I am buying, because there are occasional things that I'll be picking up. But I think looking at this, looking at the uncertainties that we're facing, particularly when you have just grossly incompetent leadership, it does make me want to say, hey, I'm going to have a more of a diversified global portfolio, because you never know, how incompetent the leadership you'll get in any given country, how bad the policies could be. And so that is something to be mindful of, to be tracking. And so, sort of hedging that political incompetence risk with a more global portfolio, considering, let's say, hyper growth companies that might, 10x in different regions of the world, where I'm saying, hey, this is more of a speculative play, but I think this has a lot of potential, while also considering companies that are, let's say, a consumer staple business that might be in like South America, that trades at a low teens multiple, and I think will be around in 25 years from now, and that they have, pricing power, and they sell, each year in, year out, a little more volume, raise prices each year. So I think it's important to have a broad range of things to consider. So the first hand is I am, having a sizable liquidity position, because you might think, well, wait a second, Daniel, Does it make sense to have a lot of cash if you have high inflation? Well, the answer long term is no. You don't want that. But the short term is that if you go through, let's say, a year or two where you have risk off, arguably cash, which is losing its purchasing power to the tune of, let's say, 10% a year, is better than holding a stock that declines 50%. So that holds its value a lot better because, so that is worth, understanding and reflecting on. That's at least how I'm considering it, a broad range of potential multi-baggers, the hyper growth companies that may still need to prove their business model and they're growing, let's say 30, 40, maybe even faster. And then looking at the, let's say, consumer staple type businesses around the world where maybe you can get them for a low teens rate, maybe paying a 5% dividend yield. And so then the last key component, and I think this is really trying to channel the Warren Buffett aspect, is really be sensitive to the valuation you're paying. And, you look at his deals, you look at what, when he was scooping up Apple, for example, he was paying like around 10 times earnings. And so now it's around 30 times earnings. And so I think that's a really helpful data point is like, look, if you look at his successful track record, it was sticking to that discipline time and time again. And I think that's my own personal reflection saying, okay, I want to be super thoughtful about, am I getting a very sensible, if not cheap valuation for what I'm looking at? Given that arguably we're in a period of increased macro concerns that could lead to a broader risk off. So I'm looking at this rally. I'm not buying it. I'm not saying, oh, go all in. I'm just super skeptical of this. Maybe it continues going. But, on the margin, I'm finding a few things to buy, little things. But for the most part, I'm looking to trim and raise my cash position. I'd absolutely love to hear your thoughts. If you have any, feel free to comment below. If you feel like, hey, Daniel, my thoughts on dollar cost averaging were off the mark, or if you feel like there's a company, if you feel like there's an unrivaled company that I should be looking at, absolutely leave a comment below. And you know what? If your pick of a company gets enough, let's say, thumbs up, maybe I'll make a video about it. So maybe like if it gets like 50 or 100 thumbs up, then I'll make a video about it. And if you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button. And if you're interested in checking out my own personal investment journey, looking for a community of investors looking to learn and find exceptional companies, check out unrivaledinvesting.com. Click join the journey. Thanks so much for tuning in.